Question 1. In the context of fixed annuities, which of the following best explains the impact of interest rate guarantees on annuity performance? A. Interest rate guarantees ensure that the annuity will increase in value at the highest possible market rate, regardless of economic conditions. B. Interest rate guarantees mean that the annuity's value will grow at a minimum rate specified in the contract, even if market rates fall below that level. C. Interest rate guarantees allow for the annuity's value to fluctuate based on the stock market, giving the annuitant a chance to earn more. D. Interest rate guarantees are only relevant if the annuity holder surrenders the annuity, ensuring a full refund of premiums paid. Answer B. Explanation. Fixed annuities provide a guaranteed minimum interest rate specified in the contract, which assures the annuitant that even if broader market rates decrease, the annuity will still earn at least this minimum rate. This feature is critical for individuals seeking stability and predictability in their investment. Answer is incorrect because fixed annuities are not designed to always match the highest possible market rate. They prioritize stability over potential for high returns. Answer C is incorrect as the value in a fixed annuity does not fluctuate based on stock market performance, which would instead characterize a variable annuity. Answer D is misleading because interest rate guarantees apply throughout the annuity's duration, not only at the time of surrender. Question 2. Scenario-based question. Mr. Larson is considering purchasing a variable annuity but is concerned about market risk and the potential impact on his retirement income. To address his concerns, his financial advisor suggests adding a guaranteed lifetime withdrawal benefit rider to his annuity. Which of the following best describes how the GLWB rider would impact Mr. Larson's annuity? A. It would guarantee that Mr. Larson's annuity value will never decrease, regardless of market performance. B. It would ensure that Mr. Larson can withdraw a fixed percentage of his annuity value each year for as long as he lives, even if the underlying investments perform poorly. C. It would allow Mr. Larson to withdraw all of his premium payments at any time without incurring surrender charges. D. It would convert Mr. Larson's variable annuity into a fixed annuity with guaranteed interest. Answer B. Explanation. A guaranteed lifetime withdrawal benefit rider ensures that the annuitant can withdraw a specified percentage of the annuity's value annually, even if the annuity's underlying investments perform poorly or decrease in value. This feature helps provide a predictable income stream for life, which is especially valuable in volatile markets. Answer is incorrect because the GLWB does not protect the annuity's actual value from decreasing, it only guarantees income withdrawals. Answer C is incorrect as GLWB does not grant unrestricted access to the annuity's full premium amount without surrender charges. Answer D is also incorrect. The GLWB rider does not convert a variable annuity into a fixed annuity, but rather adds a feature to secure lifelong income. Question 3. In the case of a 1035 exchange, which of the following statements best describes an allowable scenario under IRS rules? A. A 1035 exchange allows for a tax-free transfer from a variable annuity to a fixed annuity, provided the ownership remains the same. B. A 1035 exchange permits a tax-free transfer from a life insurance policy to a fixed annuity, but not from an annuity to another annuity. C. A 1035 exchange allows for tax-free transfers between any financial product, including mutual funds, as long as it remains in the annuitant's name. D. A 1035 exchange allows for a tax-free transfer from a fixed annuity to a variable life insurance policy, but only if the surrender charges are waived. Correct answer A. Explanation. A 1035 exchange allows a policyholder to transfer an annuity to another annuity, either fixed to fixed, fixed to variable, or variable to fixed, without triggering a taxable event as long as the ownership of the contract remains the same. This rule facilitates adjusting investments without incurring tax consequences. Answer B is incorrect because the 1035 exchange does allow annuity-to-annuity transfers and does not restrict the exchange to life insurance to annuity transfers only. Answer C is incorrect as 1035 exchanges do not apply to non-insurance products like mutual funds. Answer D is incorrect because IRS regulations do not permit tax-free exchanges from annuities to life insurance products under a 1035 exchange. Question 4. Which of the following best describes the role of the Wyoming Insurance Department in regulating annuities? A. The Wyoming Insurance Department enforces both federal and state securities laws on annuities sold within the state. B. The Wyoming Insurance Department oversees the suitability standards for annuity sales to ensure products meet consumers' financial needs. C. The Wyoming Insurance Department provides a guarantee on annuity contracts covering any potential financial losses due to market fluctuations. D. The Wyoming Insurance Department is responsible for setting minimum guaranteed interest rates on all fixed annuities. Answer B. Explanation. The Wyoming Insurance Department is responsible for regulating annuity sales within the state, including enforcing suitability standards to ensure that products align with the consumer's financial needs and objectives. Answer is incorrect because while the Wyoming Insurance Department does enforce certain state regulations, federal securities laws are primarily enforced by federal agencies like the SEC. Answer C is incorrect because the Wyoming Insurance Department does not guarantee annuity contracts against market losses. Answer D is also incorrect, as the Wyoming Insurance Department does not set guaranteed interest rates. These are determined by the issuing insurance company within regulatory limits. Question 5. An individual annuitant who chooses a life with period certain payout option would receive payments for which of the following durations? A. For a specified period only with no payments guaranteed beyond that period. B. For their lifetime, with payments continuing to a beneficiary if they pass away before the end of a predetermined period. C. For the lifetimes of both the annuitant and a joint annuitant, with payments ceasing when either passes away. D. For the longer of the annuitant's lifetime or the lifetime of a contingent beneficiary. Answer B. Explanation. The life with period certain option provides lifetime payments to the annuitant and guarantees that if the annuitant passes away before a certain period ends, payments continue to a beneficiary for the remainder of that period. Answer is incorrect because a life with period certain includes lifetime payments, not a fixed term only. Answer C is incorrect as it describes a joint life option which pays out based on both individuals' lifetimes. Answer D is incorrect as it does not align with the period certain aspect which is set for a specific term, not based on a contingent beneficiary's lifetime. Question 6. Which of the following statements about the tax treatment of annuity withdrawals is most accurate? A. Withdrawals from an annuity are tax-free if taken after age 591. B. Withdrawals are taxed as ordinary income, with early withdrawals before age 591 were potentially subject to an additional 10% penalty. C. Withdrawals are taxed as capital gains, regardless of the annuitant's age at the time of withdrawal. D. Withdrawals from annuities are tax-free as long as they do not exceed the principal amount invested. Answer B. Explanation. Withdrawals from an annuity are generally taxed as ordinary income, with an additional 10% early withdrawal penalty applied if the annuitant is under age 591, unless certain exceptions apply. Answer is incorrect as withdrawals after age 591 were not tax-free, they are still taxed as ordinary income. Answer C is incorrect because annuities do not receive capital gains treatment. Instead, distributions are subject to ordinary income tax. Answer D is incorrect because tax on withdrawals is based on the last in, first out rule, meaning that taxable gains are withdrawn first, regardless of the principal amount. Question 7, scenario-based question. Mrs. Harris, age 62, is considering a single premium immediate annuity to supplement her retirement income. She wants a guaranteed income stream but is concerned about inflation eroding her purchasing power over time. Which annuity feature would best address her concern? A. Guaranteed minimum withdrawal benefit, B. Period certain option, C. Inflation protection rider, D. Lump sum withdrawal option. Answer C. Explanation. An inflation protection rider adjusts annuity payments to keep pace with inflation, helping preserve the purchasing power of the annuity income over time. This option is beneficial for individuals like Mrs. Harris who are concerned about inflation. Answer is incorrect because a GMWB ensures a minimum withdrawal but does not adjust for inflation. Answer B is incorrect as the period certain option simply ensures payments for a set term and does not provide inflation adjustments. Answer D is incorrect because a lump sum withdrawal option would deplete the annuity's value and does not address long-term purchasing power concerns. Question 8. In an indexed annuity, which of the following most accurately describes how interest is credited to the annuity? A. Interest is credited at a fixed rate, unaffected by changes in market indices. B. Interest is credited based on the performance of an index, but with limits such as caps and participation rates set by the insurer. C. Interest is credited directly from gains in the stock market, allowing for high returns with no limits. D. Interest is credited only at the end of the contract period, based solely on market performance. Answer B. Explanation. In an indexed annuity, interest crediting is tied to the performance of a specific index like the S&P 500, but the insurer sets caps, limits on maximum gains, and participation rates percentage of index gains credited to the annuity. This structure allows for some market-based growth while controlling risk exposure. Answer: it is incorrect, as fixed annuities have fixed rates, not indexed annuities. Answer C is incorrect because indexed annuities do not credit full market gains, and they have caps and participation limits. Answer D is incorrect because indexed annuities typically credit interest periodically, not solely at the contract's end. Question 9. Which of the following statements is true about annuitization in an annuity contract? A. Once annuitization begins, the contract owner can no longer make additional withdrawals from the contract balance. B. Annuitization allows the annuity owner to keep access to the entire contract value in addition to receiving regular income payments. C. Annuitization allows the annuity to be converted to a lump sum payout without income tax consequences. D. Annuitization can be reversed at any time, allowing the owner to switch back to accumulation phase if desired. Answer A. Explanation: annuitization converts the annuity's accumulated value into a stream of income payments, and once this process begins, the contract balance is typically no longer accessible for additional withdrawals. Answer B is incorrect because the contract balance is converted to income payments, so access to the total balance is restricted. Answer C is incorrect, as lump sum withdrawals after annuitization are generally not allowed, and annuitization distributions are taxed as income. Answer D is incorrect because annuitization is generally irreversible once started, meaning the owner cannot revert to the accumulation phase. Question 10. What is the primary purpose of a free look period in an annuity contract? A. To allow the contract owner to withdraw any funds without penalty. B. To enable the contract owner to review the contract terms and cancel without penalty if they change their mind within the specified period. C. To provide a period where the contract owner can lock in the annuity rate. D. To offer an initial phase in which annuity payouts are tax-free. Answer B. Explanation: a free look period is a regulatory feature that gives the contract owner a specified amount of time, often 1030 days depending on state regulations, to review the annuity contract and cancel it without penalties if they decide it doesn't meet their needs. Answer is incorrect, as the free look period does not permit penalty-free withdrawals of funds, but rather a cancellation option. Answer C is incorrect because the free look period is unrelated to rate locks. But answer D is incorrect, as the free look period does not offer any tax advantages related to annuity payouts. Question 11. Which of the following best explains the concept of a tax-deferred growth in an annuity? A. The annuity's growth is entirely tax-free and will not be taxed at any point. B. Taxes on the annuity's earnings are delayed until withdrawals are made, allowing the investment to grow without immediate tax implications. C. Taxes on both contributions and earnings are permanently deferred and not subject to income tax. D. The annuity's growth is taxed each year, but at a lower rate than standard income. Answer B. Explanation: in an annuity, tax-deferred growth means that earnings within the contract grow without immediate tax. Taxes are only due when withdrawals or distributions are made. This allows for a compounding effect over time, as earnings are reinvested and continue to grow tax-free until withdrawn. Answer is incorrect because taxes are deferred, not avoided permanently. Answer C is incorrect, as only earnings, not contributions, are subject to tax deferral. Answer D is incorrect, since taxes on annuities are deferred until distribution, not taxed annually. Question 12. What is the primary difference between a fixed annuity and a variable annuity? A. A fixed annuity offers a guaranteed minimum interest rate, while a variable annuity's return depends on the performance of chosen investment options. B. A fixed annuity provides tax-free growth, while a variable annuity is subject to annual taxes. C. A fixed annuity includes options for market-based returns, while a variable annuity is limited to a fixed rate of return. D. Both fixed and variable annuities offer returns based on the stock market, but variable annuities have fewer restrictions. Answer A. Explanation: fixed annuities provide a guaranteed minimum interest rate, offering more predictable returns, while variable annuities' returns depend on the investment performance in selected sub-accounts, such as mutual funds. Answer B is incorrect because both annuities allow for tax-deferred growth, not tax-free growth. Answer C is incorrect, as only variable annuities are linked to market performance, whereas fixed annuities offer a stable guaranteed rate. Answer D is incorrect, since variable annuities are more market dependent than fixed annuities and have higher risk levels. Question 13. Scenario-based question. Mr. Wilson, age 58, is considering withdrawing $50,000 from his deferred annuity to cover unexpected medical expenses. Which of the following will he most likely face? A. Ordinary income tax on the withdrawal, but no penalty due to his age. B. Ordinary income tax and an additional 10% penalty for early withdrawal. C. A 10% early withdrawal penalty only without any additional income tax. D. No tax or penalty due to the withdrawal being for medical expenses. Answer B. Explanation. Since Mr. Wilson is under the age of 591, any withdrawal he makes from his deferred annuity would typically be subject to ordinary income tax and an additional 10% penalty for early withdrawal, while some exceptions exist, such as for certain medical expenses exceeding a specific percentage of adjusted gross income, they don't automatically apply. Answer is incorrect because withdrawals are subject to both ordinary tax and penalty before 591 were. Answer C is incorrect as both income tax and penalty apply. Answer D is incorrect as not all medical expenses qualify for penalty waivers. Question 14 weighs the primary advantage of choosing an annuity payout option with an exclusion ratio. A. It allows tax-free withdrawals from the annuity for a fixed number of years. B. It provides a method for determining the tax-free portion of each payout by considering the annuity's cost basis. C. It guarantees that the principal investment is returned without any taxation. D. It provides a fixed percentage of the annuity income that is guaranteed by the issuing company. Answer B. Explanation. The exclusion ratio is used to determine the tax-free portion of each annuity payout. It accounts for the cost basis, the amount of money initially invested, which is not subject to tax upon withdrawal, and calculates how much of each payment represents a return of principal versus taxable income. Answer is incorrect because the exclusion ratio doesn't create tax-free payments, but rather portions of tax-free principal. Answer C is incorrect as only the return of principal is tax-free, not the entire payout. Answer D is incorrect because the exclusion ratio relates to tax treatment, not guaranteed income. Question 15. Which of the following best describes the accumulation phase of an annuity? A. The period when the annuity holder begins receiving income payments. B. The initial period where the annuity holder makes contributions and earnings grow on a tax-deferred basis. C. The period when the annuity holder must make minimum required distributions. D. The period when the annuity holder can no longer make additional contributions. Answer B. Explanation. The accumulation phase of an annuity is the period during which the contract holder contributes funds and the value grows tax-deferred. This phase lasts until the annuity is annuitized or income payments begin. Answer is incorrect because that describes the payout phase. Answer C is incorrect because there are no required minimum distributions in the accumulation phase. Answer D is incorrect since additional contributions can typically be made during this phase, depending on the type of annuity. Question 16. Which of the following is most accurate regarding the guaranteed lifetime withdrawal benefit provided in an annuity? A. It allows withdrawals for life even if the annuity's balance drops to zero. B. It guarantees a fixed interest rate on all withdrawals. C. It ensures that withdrawals are tax-free. D. It allows for unlimited annual withdrawals without penalties. Answer A. Explanation. The guaranteed lifetime withdrawal benefit provides a guarantee that the annuity holder can withdraw a set annual amount for life, even if the annuity's account balance is depleted. Answer B is incorrect as the GLWB does not provide an interest rate guarantee. Answer C is incorrect because withdrawals are subject to taxation. Answer D is incorrect as GLWB typically limits withdrawals to a specified percentage annually, not unlimited withdrawals. Question 17. In Wyoming, which of the following is required to ensure the suitability of annuity products sold to consumers? A. The consumer must have an annual income exceeding $100,000. B. The annuity must meet the financial and retirement goals of the consumer based on a detailed assessment of their needs. C. The consumer must have a minimum level of financial literacy confirmed by a written assessment. D. The annuity must offer a guaranteed return of at least 5% per year. Answer B. Explanation. Wyoming suitability standards require that an annuity recommendation aligns with the consumer's financial and retirement needs based on their financial status, objectives, and risk tolerance. This suitability assessment helps protect consumers from inappropriate or unsuitable annuity sales. Answer is incorrect because income level alone doesn't determine suitability. Answer C is incorrect as financial literacy is not mandated for suitability. Answer D is incorrect because a guaranteed return is not a requirement for annuity suitability. Question 18. When considering an indexed annuity, what is a key factor that differentiates it from a fixed annuity? A. An indexed annuity offers a guaranteed fixed interest rate with no market-based adjustments. B. An indexed annuity provides returns based on the performance of a chosen market index but typically includes caps and participation rates. C. An indexed annuity guarantees the full market returns of an index without any limitations. D. An indexed annuity offers guaranteed returns and can be cashed out penalty-free at any time. Answer: B. Explanation. Indexed annuities provide returns based on a market index, such as the S&P 500, but they include limitations like caps, maximum return limits, and participation rates percentage of index gains credited. This allows some market exposure while controlling potential returns. Answer is incorrect because that describes a fixed annuity. Answer C is incorrect as indexed annuities do not guarantee full market returns. Answer D is incorrect as penalties may apply for early withdrawals. Question 19. Scenario-based question. MS. Garcia has invested in a variable annuity with multiple sub-accounts that include a range of stock and bond funds. Recently, she noticed her account value has fluctuated due to market conditions. Which of the following is the primary reason for these fluctuations? A. Her annuity is structured with a fixed interest rate that adjusts semi-annually. B. Her variable annuity's value is tied to the performance of the investment sub-accounts, which can fluctuate with market conditions. C. The annuity's account value only decreases due to administrative fees with no market impact. D. Her variable annuity includes a guaranteed minimum return that eliminates any real market risk. Answer: B. Explanation. In a variable annuity, the account value fluctuates based on the performance of the chosen investment sub-accounts, which are affected by market conditions. This allows potential growth but involves risk. Answer is incorrect because a variable annuity's interest rate is not fixed. Answer C is incorrect as fluctuations are market-driven, not just due to fees. Answer D is incorrect as variable annuities do not typically guarantee a minimum return unless a specific rider is purchased. Question 20. Which of the following is an advantage of the 1035 exchange in annuities? A. It allows a tax-free transfer from one annuity contract to another, preserving the tax-deferred status. B. It provides a means for converting an annuity into a mutual fund without incurring taxes. C. It allows the policyholder to withdraw funds from the annuity with no penalties. D. It provides a guaranteed return on the new annuity regardless of market conditions. Answer A. Explanation. The 1035 exchange is a provision in the U.S. tax code that allows for a tax-free transfer of funds from one annuity to another without losing the tax-deferred status of the investment. This can be beneficial for annuity holders who want to switch to a new annuity product with better terms or features without triggering a taxable event. Answer B is incorrect because a 1035 exchange does not allow conversions to mutual funds. It is limited to insurance products like life insurance and annuities. Answer C is incorrect as a 1035 exchange is not a withdrawal but a transfer, and answer D is incorrect because a 1035 exchange does not guarantee returns on the new contract. Question 21. Which type of annuity payout option provides payments only for the duration of the annuitant's life with no payments made to any beneficiaries after the annuitant's death? A. Life with period certain. B. Joint and survivor. C. Life only. D. Lump sum withdrawal. Answer C. Explanation. A life-only annuity payout option pays income for the duration of the annuitant's life, ending payments upon the annuitant's death. This option typically provides the highest payment amount compared to other options because it does not include provisions for beneficiaries after the annuitant's death. Answer A. Life with period certain provides income for life but guarantees payments for a certain period even if the annuitant dies. Answer B. A joint and survivor continues payments after the first annuitant's death to a survivor. Answer D. A lump sum withdrawal. This is a one-time payment option and not a life-based annuity payout. Question 22. In a variable annuity, which of the following is the primary risk that an investor faces? A. Inflation risk. B. Interest rate risk. C. Investment risk. D. Mortality risk. Answer C. Explanation. In a variable annuity, the account's performance depends on the underlying investments chosen by the annuitant, which means that the investor faces investment risk. If the chosen investments perform poorly, the value of the annuity may decrease. Answer A. Inflation risk affects all types of investments but is not the primary concern in variable annuities. Answer B. Interest rate risk mainly affects fixed annuities. Answer D. Mortality risk pertains more to life insurance products than to the investment performance of variable annuities. Question 23. Which of the following accurately describes the purpose of the free look period in an annuity contract? A. To allow the insurer to adjust the premium based on the annuitant's risk profile. B. To give the policyholder a limited time to review and cancel the contract for a full refund. C. To permit the policyholder to switch to a different annuity type without penalties. D. To lock in the annuity's interest rate for the duration of the contract. Answer B. Explanation. The free look period is the timeframe provided by annuity contracts allowing policyholders to review the contract terms and decide whether to keep or cancel the contract. If the policyholder decides to cancel within this period, they are eligible for a full refund. Answer is incorrect as the premium adjustment is not related to the free look period. Answer C does not apply as the free look period is not intended for switching annuity types. Answer D is also incorrect. Interest rate lock-in terms are separate from the free look period. Question 24. Mary has a deferred annuity and decides to take early withdrawals. What will likely happen if Mary is under the age of 591? A. She will face only surrender charges, but no additional taxes. B. She will incur a 10% IRS penalty on the withdrawn amount in addition to ordinary income tax. C. She will receive a tax-free distribution due to early withdrawal. D. She will avoid penalties if she reinvests the money in a different annuity within 60 days. Answer B. Explanation. If Mary takes withdrawals from her annuity before age 591, she will generally incur 10% IRS penalty in addition to ordinary income tax on the withdrawn amount. Answer is incorrect because surrender charges are separate from IRS penalties. Answer C is also incorrect as distributions are generally not tax-free. Answer D does not apply to annuities as there are no provisions allowing a tax-free rollover between annuities within 60 days that would avoid penalties. Question 25. In an indexed annuity, the interest credited to the contract is typically based on A. The total return of a mutual fund, B. A fixed interest rate set by the insurer, C. The performance of a stock market index with limits on gains, D. Daily changes in currency exchange rates. Answer C. Explanation. Indexed annuities credit interest based on the performance of a specified stock market index, such as the SP 500 with a cap on gains and sometimes a minimum guarantee. This setup allows for potential growth linked to the index but limits the annuitant's gains. Answer is incorrect as indexed annuities are not based on mutual fund returns. Answer B is also incorrect as fixed annuities are fixed interest, not indexed ones. Answer D does not apply as currency exchange rates are unrelated to indexed annuity calculations. Question 26. Which of the following is an advantage of choosing a joint and survivor annuity payout option? A. It provides higher monthly payments compared to a life-only payout. B. It continues payments to a second person after the primary annuitant's death. C. It has no fees or charges associated with it. D. It guarantees a lump sum payment at the end of the annuity period. Answer B. Explanation. A joint and survivor annuity continues payments to a designated survivor, often a spouse, after the primary annuitant's death, ensuring ongoing financial support. Answer is incorrect, as joint and survivor options typically result in lower payments than a life-only due to the extended duration of payments. Answer C is also incorrect, as there may still be fees and charges. Answer D does not apply to this payout option, which does not guarantee a lump sum. Question 27. Scenario. Mr. Green, age 65, wants a guaranteed income that will continue for both him and his spouse as long as either of them lives. He is considering a few annuity options. Which option best meets his need? A. Life-only annuity. B. Joint and survivor annuity. C. Lump sum withdrawal. D. Fixed annuity with period certain. Answer B. Explanation. The joint and survivor annuity best meets Mr. Green's requirement, as it provides guaranteed income that will continue for the life of both the annuitant and the spouse. Answer A. Life only. It stops payments upon the annuitant's death, leaving the spouse without income. Answer C. A lump sum withdrawal is not an income stream and does not provide ongoing payments. Answer D would provide payments for a fixed period only, potentially leaving the spouse without income after that period ends. Question 28. What is the primary purpose of the mortality and expense fee in a variable annuity? A. To cover the costs associated with issuing and managing the annuity. B. To guarantee the annuitant's investment will not decrease in value. C. To ensure that interest rates remain competitive in the market. D. To provide tax advantages to the annuitant. Answer A. Explanation. The mortality and expense fee in a variable annuity covers administrative costs and provides a death benefit that guarantees beneficiaries receive a minimum value, typically the original investment, even if the account has lost value. Answer B is incorrect. The AMI fee does not guarantee investment value but covers death benefits and expenses. Answer C and D are also incorrect as these do not relate to AMI fees. Question 29. Which of the following describes a tax advantage of annuities? A. All withdrawals are tax-free after age 70. B. Annuities offer tax-deferred growth on earnings until funds are withdrawn. C. Annuities provide a deduction on taxable income each year. D. Contributions to an annuity are tax-deductible up to a certain limit. Answer B. Explanation. Annuities allow earnings to grow tax-deferred, meaning the owner does not pay taxes on the growth until they withdraw funds. Answer is incorrect. Annuity withdrawals are taxed as ordinary income regardless of age. Answer C and D are also incorrect. Annuities generally do not provide annual deductions, nor are contributions tax-deductible in most cases. Question 30. Which of the following scenarios would typically be subject to surrender charges in an annuity? A. An annuitant who withdraws funds after the free look period but within the first 5 years of the contract. B. An annuitant who takes the full annuity payout at age 65. C. An annuitant who dies before the annuitization phase. D. An annuitant who converts a variable annuity to a fixed annuity within the same company. Answer A. Explanation. Surrender charges typically apply if an annuitant withdraws funds within a set period, often the first 5 to 7 years after the contract is issued. Answer B is incorrect, as taking a payout after annuitization typically avoids surrender charges. Answer C is also incorrect, because annuity death benefits are generally not subject to surrender charges. Answer D is incorrect, because converting an annuity type within the same company does not typically incur surrender charges.